There are many who talk about a bubble, some liken it back to 99, 2000. Anything in today's equity trade that says bubble to you?
We do not believe we are in a bubble anything like we were in the late 90s. I was there, and the technologies weren't ready. The costs were too high, too much capital, chased too few opportunities too soon. The seeds for what is happening now were planted during the 20 years that ended in the tech and telecom bubble, and they've been germinating for 25 or 30 years. So we believe we're ready for prime time.
Coming up in today's review, stocks finish lower, led by Nvidia on the back of a mixed jobs report. Gold hits new all-time highs, along with Bitcoin. And did we just see a blow-off top? And what an interesting finish to the week we've just had. Bit of a spinning doji on the S&P 500 after we found new all-time highs early this morning. Just after we opened up, then we peaked out at 10 a.m. and pretty much rolled over into the afternoon and finishing down near lows. With the Magnificent 7 not having a magnificent day at all, down 2.5% as a group, putting in this big bearish engulfing candle, and the Nasdaq falling 1.44% on huge volume and also on a momentum sell signal. Was an interesting day in the market. We saw a bit of rotation and some huge volumes out there. We've got a bit of a bounce here in Apple, which has been the weakest of the group lately, along with Alphabet trading up and some of the stronger ones, Meta, falling a bit. Microsoft continuing to consolidate. However, the real standout today, Nvidia, huge volume. Almost 113 million shares traded. We fell 5.5%. We're continuing to fall after hours as I speak. Just going down to the 5-minute chart after hours, we're accelerating on the downside in post-market trading. And just going to the 15-minute chart, we got a number of momentum thrusts on the downside on huge volume. And so in technical analysis, this is called a bearish engulfing candlestick pattern, where we've gapped up, traded a little higher, then fell over and closed below yesterday's low. So this candle is engulfing the previous candle, and that too is on one of my momentum sell signals. And even though we saw a similar pattern in super microcomputer a few weeks back, it actually held on and traded a bit higher. However, what's different today is the semiconductor sector as a whole had been in a parabolic grind that whole time, and it too has just put in a big bearish engulfing candlestick pattern today on really big volume and on a momentum sell signal. And we can see that in the heat map, really bright red coming out of the semiconductor sector, which was quite a bit of bearish breadth across the board there. And like I said, there's a bit of a rotation into what had been weak lately. Not only just Apple and Alphabet, but also energy, oil and gas, REITs, catching a bid, along with financials kind of holding ground there. And there's a look at the weekly heat map. Still had Nvidia close high for the week. Have a look across the rest of the Magnificent 7. We're getting some pretty good falls here. Apple 5%, Tesla 13.4%, Amazon and Alphabet came off. Also some other leaders like Eli Lilly finishing the week lower, and software stocks as a whole down for the week. While the defensive sector utilities actually put in a good week. Oil and gas was mostly higher, along with the leading sector industrials, putting in a pretty good week. But like I said, this was a really heavy volume day, even for a Friday, which is normally a bit more busy, especially on a big economic data day like jobs report like we got this morning. But even still, Nvidia did a huge 7.7 billion in notional call option volume today. Multiples of the S&P 500, which was busy as well. And we've still got other hot stocks like AMD, MicroStrategy showing up in the volume leaderboard, along with one of the biggest days in the options market we have seen in quite some time. Almost 58 million contracts traded today, still really lopsided 58% calls. And so this market has been technically overbought for quite some time now. We can see that in the fear and greed index in the blue line here, having crossed above 70 in mid-December. And apart from a few brief dips down to the low 60s, it's pretty much stayed above 70 going on 3 months now. The last time we saw an extended period of time of overboughtness was in June last year through to late July, before the S&P 500 eventually rolled over 10% and we bottomed out in late October. We've also got other sentiment indicators nearing record bullish readings like the AAII sentiment survey. Bullish readings being as high as we've seen in the last year. Same with active managers exposure index. The 4-week moving average quite elevated as well. However, contrasting that, we've got corporate insiders increasing and increasing their selling as the market has risen, whilst buying is pretty much remained flat this whole rally off the October lows. And so we all know we've got quite a bit of concentration in this market. The top 10 largest stocks now making up record levels of the S&P 500 and Nasdaq. And just like the late 90s, before the end of the tech boom, the last couple of years currently, we've also seen the top 10 largest stocks give really high contributions to the annual S&P 500 return. Currently, we're tracking at about half, which has never held that amount by the time we get to the end of the year. And just like we can see in the sentiment indicators, there's still plenty of optimism and bullishness out there. Still getting articles like this, why the stock market bull run is far from over. The AI revolution is here. The market is set to rise 10%. The bull market will continue, so on and so forth. However, we did see the most important stock in the market now, Nvidia, which is also the third largest stock in the world, just have its worst day in more than a year, along with the whole semiconductor sector. And this was on a day when we got a bit of a mixed jobs report. You could look at it a lot of different ways. The headline, net new jobs added for February, beat at 275,000 jobs compared to 200,000 expected. However, we also saw the unemployment rate come in higher than expected as well, 3.9% versus 3.7%. We also got December and January numbers collectively revised downwards, showing 167,000 less jobs than previously thought. That's why it's good to look at 3-month averages to kind of iron out the noise. Is pointing upwards in a bit of an uptrend. So like we've been saying for a while, the economy and jobs market is hanging in there pretty good, if not growing. And you might be wondering, how did the economy add more jobs than expected while the unemployment rate rose at the same time? Well, that can be due to a few things. Mostly the number of people available to work has increased as well. So we got a lower participation rate than expected. And so even though the economy added 275,000 net new jobs, it also added more people than that available to work. Hence the rise in the unemployment rate. But also, we've got a bit of a trend here, potentially starting with full-time workers looking to have turned down while part-time payrolls increase. So it can also be things like people taking on multiple jobs, a second part-time job, things like that. And if that's a little confusing, don't worry, because even the economist I respect the most, Mohammed Al-Iran, said he's paralysed by the ambiguous jobs report, going on to say people will see in this report what they want to see. If you think the labour market is too hot, you will point to the beat, you will point to the increase in hours worked. If you think that the labour market is just right or softening, you will point to the revisions, and you will point to hourly earnings. And there's a look at the numbers. Average hourly earnings came in a little lower than expected. Same with the participation rate. Month over month, hourly earnings lower. There's the beat on the headline and the unemployment rate. And just looking at the SAM rule from Claudia Sam, and that's basically using the 3-month moving average of the unemployment rate relative to its lowest reading during the previous 12 months. And when that average goes above 0.5, it triggers, normally means we're in a recession already, or it's just about to begin. So we heard it straight from Claudia today. The SAM rule did not trigger. We are not in a recession. 3-month averages are your friend. And so I had an idea today and was playing around with something and created a spread chart of the S&P 500 versus the unemployment rate, which you can see here in the blue line. And this is a monthly line chart. And the yellow line is a simple 24-month moving average. So a 2-year moving average of the spread between stocks and the unemployment rate. With my theory being that stocks are pretty good at reacting quickly to things around the corner. And so if this spread turns down sharply, that means stocks are coming down and the unemployment rate's going up, and vice versa. When the spread's going up, stocks are rising, the unemployment rate is going down. So that means bull market. And what I've seen is it's pretty accurate compared to some other measures I've seen, yield curve, and another one I look at, the 20-month moving average of the unemployment rate itself, which has actually triggered a recession signal. This one did briefly trigger back in September, October last year, a little bit before the unemployment signal as well. However, it's climbed back up and there's quite a big gap here. And just going back in history, whenever the spread goes below its 24-month moving average, like it did in early 2020, we got the recession, which is shaded in the grey in the chart. Saw the same thing in late 2007. The spread went underneath its moving average, recession came few months later, and again in the late 90s. It foresaw the recession coming in January 2001. Same thing in 1990, in the 80s, and in the 70s, and even going all the way back into the 60s and 50s. This indicator gave some insight into the potential of an upcoming recession. So whilst we've had an inverted yield curve for a record time over a year and a half, some other measures of recession around the corner as well. Like the SAM rule, this one doesn't look to be giving us a signal right now, even though it briefly gave us one in October last year. However, with that unemployment rate approaching 4%, that's probably going to give the Fed permission to cut rates, which it sounds like they really want to do now, as they want to get out in front of a potential recession. Even though we don't have all the signs that it's here or around the corner, they also want to allow the Treasury to refinance a huge amount of debt, and no doubt a few rate cuts will help the Biden administration as well. That's what we heard from former Fed President James Bullard today, saying this jobs report increases the chance of Fed cutting interest rates sooner. And the bond market is pricing in that as well. That's why we've got Treasury yields falling, along with Fed fund futures approaching a 1 in 3 chance. They might even cut in May. However, it's looking like almost a given they're going to cut in June. The 2-year bond yield dipped quite a bit today as well. Got down to 441, along with the 10-year, just above 4% now. So I think we can pull the support box all the way over, and the middle of that is 385. And if the 10-year were to go underneath that, that could be the bond market pricing in a recession. However, if it were to stay above that, that could kind of be the sweet spot for the stock market as well. And with that dovish talk from Jay Powell, lower bond yields, that's helping to weaken the dollar, which fell again today, getting down to 102.3. And that's a good tailwind for gold, which likes a weaker dollar. And we can see that there today. Ripping up again, getting above 2,200 an ounce for the first time ever on pretty strong volume as well. There's a bit of momentum building in this market. I can see in my range strength indicator. However, we may be a little technically overbought in the short term, but this thing has been consolidating for a few months now. We can see that with buy-sell bands coiling up a little bit. Then we've got that explosive volume breakout with the momentum thrust, and so this could continue walking the line for some time yet. And it may be part of the defensive rotation in the market today. We saw some other sectors like utilities and energy actually finish higher. We've got a lot of growth stuff coming off the boil. Could also be a bit of a hedge on geopolitical tensions, and that monthly chart is looking pretty good as well. Breaking out of a long-term ascending triangle. It's been forming for over 3 years, and just going over to silver on the monthly chart. That too could be interpreted as a bullish chart pattern, bit of a pennant. And silver versus gold, some of the cheapest ratios we've ever seen. And silver is normally a lot more volatile than gold, so it could too catch up, as it's still well off its highs from 2011. When it got up to almost $50 an ounce. Still a little bit less than half of that now. And even though we saw some hot areas of the market come off today, like semiconductors and AI stocks, didn't really spill over to crypto. We actually saw Bitcoin trading up to all-time highs above $70,000 a coin before it retraced, and we're currently just sitting a bit above $68,000 a coin. And so this could still be a bit of a topping candle we got on the 5th of March. Just looking at the 15-minute chart, once again, like earlier in the week when we broke out to new all-time highs, a lot of people offloaded into that, and they did again today. As soon as we got above $70,000 here, big volumes came in and offloaded into that, and we've just retraced a bit off that. And looking at the daily chart of the largest Bitcoin ETF, IBIT, that too there is a bit of a bearish signal, along with some bearish reversal signals. However, they're still yet to be confirmed. Another area of the market that did well today was cannabis stocks. After Biden mentioned in his State of the Union speech that a review is underway by the DEA of cannabis, and so it should be very likely they do come out and reschedule it from 1 to 3. And that should pave the way for further federal legalization. After the Department of Health and Human Services recommended all the way back in August for the DEA to reschedule it, and that could remove the real burdensome 280E tax measure that cannabis companies have to pay millions because they're not allowed to claim standard business deductions. Not to mention, they don't get access to the federally insured banking system, so they have to deal more in cash, increases their crime, and they can't get good financing terms either. Hopefully all those hurdles are removed in the coming months, and we can get a good bounce in the most liquid cannabis ETF, MSOS, which finished up 4.5% today in an otherwise weak tape. Other areas of the market working today were Chinese securities, continued little bounce in clean energy, international stock indices, all finished the Friday session lower, except for the Aussie 200, which pretty much came in flat. Other sectors working today is energy, which is drifting a little higher here, breaking out multi-month highs. Gold mine is still holding there. Utilities finished a little higher, along with REITs, which are liking the prospects of lower rates coming. And then just looking at factors, growth came off, momentum came off pretty hard as well, almost 2% on a bit of a bearish engulfing and momentum sell signal after it's been on quite the rip since October. And then we actually saw low volatility and dividend shares finish higher, along with microcaps as well, touch higher. But some of the hottest stocks came off, like ARM down 6.6%, AMD, big shooting star on volume. Taiwan Semi, that's a bearish candle. Big Bear AI got crushed after earnings, down 31%. And then some of these other hot stocks like DraftKings, CrowdStrike, Vertiv, Wingstop, and Abercrombie and Fitch coming off pretty hard today, 7% on some momentum sell signals as well. And these have been some of the hottest stocks in the market quite some time now, and we're getting a bit of bearish breadth in them, led by the big fella Nvidia, which is now trading down quite a bit after hours as I speak, 2.2%. Add that onto the 5.5%, and that's quite a bit of volatility, down 7.7% now for the day. And the semiconductor sector, the biggest losing sector today by far on huge volume, also trading down after hours, obviously, as Nvidia is the largest holding. And normally, because the way it's constructed, the VIX will fall on Friday. However, actually popped up a little bit here today, over 2%, briefly getting above 15.5. So we've got a bit of an uptick in volatility. And just looking at the weekly chart, actually finished the week 12% higher, even though the S&P 500 was pretty much unchanged on the week. And looking out to next week, we got the most important economic data coming on Tuesday, after we got the second most important data today, the jobs report. That's CPI, due out Tuesday morning. Month over month, it's expected to have climbed to 0.4%. Core inflation year over year is expected to have increased 3.7%, and headline year over year expected to be the same as January, 3.1% increase. So that could be a catalyst for a bit of a sell-off. Either way, whatever the print, big money and algos may just use that as a liquidity event to reposition their portfolios after we've been on quite a tear for a while now. And just that price action we got and the Magnificent 7 today, we can see that candle is unlike anything we've had for quite some time. Doesn't mean it's 100% guaranteed to play out. The odds on it just maybe 60% or so that we've seen a short-term top, and it could have a short-term correction where I'd imagine the dip would be bought unless we got any big surprise, maybe a nasty uptick in CPI, or still the potential of a recession as well, which if we did get, might mean we did indeed just see a blow-off top, maybe for quite some time. As always, we won't really know until we're in the middle of it. All we can do here is speculate and look at patterns, but the ingredients are there for a bit of a pullback, looking at how hot the options market's been for a while, sentiment indicators, and like I just showed you guys, all these hot stocks coming off quite a bit today, whilst we're seeing a bit of a rotation into some safer stuff. That's all I got for you this week. Thanks very much for tuning in every day to the Click Capital Daily Market Review and supporting this channel by hitting that like button and dropping a comment. I reply to everyone, so I'm always interested to hear your thoughts on this market and maybe something I might have missed. Other than that, enjoy your weekend, and I look forward to making another video for you guys come Monday night. Cheers.